So, good evening and welcome to Lupin Limited Q4FY23 earnings conference call. Please note that all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the opening remarks. Please note that this conference is being recorded. I now hand the conference over to the management. Thank you, and over to you.
Hi everyone, this is Vinita here. Very pleased to welcome you to our Q4 earnings call. I have with me our MD Nilesh as well as our CFO Ramesh. We are very pleased to close the fiscal year with continued improvement in operating margins. Our team has had a sharp focus, as you know, on getting our India business back to double-digit growth and quarter after quarter improvement in US margins as well. This focus, along with growth in other areas like API, EMEA, and APAC, enabled us to deliver margin improvement as planned. We are committed to sustaining this positive momentum into the new fiscal year and driving strong growth across all our regions, in particular in India, based on our recent Salesforce expansion and the US, aided by material new product launches. Our India business, as you would have noted, recorded an 11% plus growth per IQVIA. Ex the diabetes portfolio, growth was 15% plus in line with the market growth. In Q4, we made a significant investment to expand our sales force in India and enhance our reach. We're very pleased that overall we delivered margin improvement for the organization despite this material investment. In the US, we improved our margins for a third quarter in a row through portfolio optimization, maximizing the high-value products, and continued cost optimization efforts. We were able to improve our margins despite increase in R&D spend quarter over quarter. Overall, when you look at it for the year, the R&D spend for the US stood at $100 million with an increasing proportion of complex generics, in particular inhalation and injectables. Apart from India getting to double-digit growth and US business improvement, our API business recovered in the quarter with demand growth in our core products. Our EMEA business grew driven by South Africa quarter over quarter and Foster, Lupin in Europe year over year. In APAC, our Philippines subsidiary performed very well. Switching to R&D, we continue to drive the shift to complex generics with a focus on respiratory and injectable products. We filed 19 products in the US and 10 ex-US. Of the US filings, we had 4 injectables, 3 nasal sprays, and we made progress on Respimat and Ellipta products on both platforms. Apart from generics, on the R&D front, we optimized the new chemical entity R&D spend in Q3 to focus on 2 of our oncology pipeline programs, significantly reducing the discovery spend. Switching to compliance, on compliance front, as you know, we have made progress in part, with positive outcomes on the Ankleshwar, Nagpur injectables, and Somerset sites. We've also made substantial progress on our remediation efforts in Tarapur, Mandideep, and Pithampur Unit 2. We are committed to ensure that we get all our sites to a consistent and sustainable level of compliance. I'm sure we'll see more progress on this front in fiscal year 24. On the M&A front, our recent acquisitions have performed well with Anglo-French, Southern Cross, Xopenex Brovana in the US, and Paloma in Brazil, all delivering per plan. Our recent acquisition of Medisol in France enables us to accelerate our injectables franchise in Europe. We are very pleased to be able to close that. We have come a long way in fiscal year 23 and are excited about the prospects in fiscal year 24 as we launch products like tiotropium, darunavir, and others in the US and drive consistent double-digit growth in our India business. We remain focused on driving operating margin improvement as we grow our business. With this, I will hand it over to Ramesh for a deeper analysis of our performance.
Thank you, Vinita. Friends, welcome to a refreshing set of numbers. We are hopeful that it sets a stage for better numbers year on. Sales for quarter 4 FY23 are at 4,330 crores as compared to 4,264 crores in Q3 FY23, which is a growth of 2% quarter-on-quarter. On a year-on-year basis, the company registered a 12% growth over Q4 FY22 sales. In the US, during the quarter, the US business registered a small degrowth of 1.3% in local currency terms on a sequential basis. The sales have come down from 177 million to 174 million in Q4. During the quarter, Albuterol sales came down marginally due to a seasonality factor. India region. India branded formulations business declined by 3.1% in Q4 FY23 versus Q3 FY23. Whilst on a year-on-year basis, the sales grew by 8.9% FY23 year-on-year. The growth was 3.3%. Overall market growth during Q4 23 was 14.9%, whilst Lupin grew by 11.3%. Lupin witnessed highest growth in Q4 as compared to the earlier quarters. Q1 was 1%, Q2 was 6.2%, and Q3 was 7.5%. Adjusted for diabetes, we are close to market growth rates, which is 14.9% versus 15.2%. Loss of exclusivity and genericization of the anti-diabetes business has impacted our growth rate, as patented portfolio is a large chunk of our diabetes portfolio. We do well apart from the top TAs of Lupin in gynecology and GI. API business. API business sales grew by 14.6% on a quarter-on-quarter basis, as core cephalosporins API sales continue the path to recovery from higher sales in Cefaclor and 7-ACCA. On year-on-year basis, sales growth was 46.4%. EMEA. Sales for EMEA region grew by 19.3%. Year-on-year was 11.4%. South Africa. Quarter-on-quarter growth of 35.3% in local currency terms, led by higher sales in various products. UK, the degrowth was 6%, but the higher sales over the last quarter is primarily driven by Foster. Germany, quarter-on-quarter degrowth of 12% was an outcome of Q3 being higher for Germany for the market due to competition stockout reasons. Growth markets. Sales of growth markets grew by 4.7% quarter-on-quarter. Philippines. Traditionally, Q4 is a strong quarter for Philippines. Nearly all divisions performed well in comparison to last year. The growth was 14%. Australia. Quarter-on-quarter and year-on-year growth was led by higher sales in our new acquisition, Southern Cross. Q3 was lower due to shipments getting deferred to Q4. Grin. Quarter-on-quarter degrowth was 23.6%, led by stock out of certain products due to plant shutdown. Brazil, quarter-on-quarter growth of 9.4% was led by acquired products from Paloma. Gross margins. This is an important here. Q4 FY24 gross margins is 59.7% as compared to Q3 FY23 gross margins of 59.8%. The sales mix, especially India regions, played a part in the slight lowering of the gross margins. Friends, at the beginning of this year, we spoke about optimization initiatives on various fronts. I'm glad to state that we did achieve good progress on some elements of the program, as in the case of sales returns, air freight, and so on, both elements of which get folded into this line. Secular inflation of over 5% in input prices has, however, eroded into the gains, marring visible progress here. We continue to work on write-offs and other initiatives, including launch of meaningful products that would make a difference to the gross margins and hence to the bottom line. The employee benefits line. Q4 FY23 is 773 crores, versus 764 crores in Q3 FY22, and 703 crores in FY22, Q4 FY22. Quarter-on-quarter increase is mainly due to field force expansion in the India region, higher bonus accruals, ESOPs in US, etc. On an ongoing basis, we expect employee costs to be around 19%. Despite the lower growth on the top line, the year-on-year increase has been only 3%, reflecting the initiatives on the workforce reduction that we carried on at various functions. This also captures a negative impact of FX translation resulting from a depreciating rupee. Manufacturing other expenses. Q4 FY23 is 1,303 crores, versus 1,333 crores in Q3 FY23. and 1,321 crores in Q4FY22. The quarter-on-quarter savings is as a result of a reduction in business settlements and other expenses of a one-time nature. Year-on-year savings is on account of a reclassification done in travel in Q4 last year from employee benefits. Friends, whilst there are savings as a result of optimization measures, the translation impact of outside India expenses, as well as an increase in sales promotion spends in India, along with minor investments in adjacent businesses, offsets the gains made. EBITDA front, operating EBITDA excluding Forex and other income is at 13.9% for the current quarter, reflecting an improvement of 170 basis points in comparison to the previous quarter. The improvement in EBITDA is primarily driven by optimization endeavors, lower other expenses, and PLI benefits. With launch of newer products and sharper focus on cost, we expect material continued optimization of EBITDA across quarters over the next year. R&D is 7% of sales at 305 crores in the current quarter, as compared to 289 crores, that's 6.8% of sales in Q4 FY22, and 8.9% in Q4 FY22. We continue to pivot to more, 289 was actually Q3 FY22. We continue to pivot to more complex products and platforms while continue to focus on costs and outcomes. Year-to-date ETR was 36.9% for the quarter. The ETR for the current quarter is only 5.9%. The lower ETR in the current quarter was mainly due to higher profit in the US, apart from normalization of accounting for the effective tax rate. Other operating income, quarter on quarter, there is an increase in other operating income on account of inclusion of PLI benefits, somewhat reduced by other settlement income, other milestones and the like. Forex gains is at about 26 crores in Q4. Again, in FY23 was Q3 FY23 was 16.6 crores. So with that, I would like to open the field for discussions.
Thank you very much, sir. We will now begin the question and answer session. Please raise your hands from the participant tab on the screen to ask questions. So the first question is from Damayanti Kerai. Go ahead, ma'am.
Yeah, hi. I hope I'm audible.
Yes.
Okay, thanks. Thanks for the opportunity. So my first question is, can you update us on the status of your tiotropium filing? Because you had earlier given 2 TADs, right? One in April and one in June. So if you can talk about it.
Yeah, so we've been in active dialogue with the agency back and forth on information requests over the last 2 months on tiotropium. The TAD date right now is on paper July and August, so instead of April and August. And we hope that we will actually get approval sooner. We've had communication on a monthly basis with the agency on the application. Just last week, they cleared a drug master file for the product, which was a very positive sign. So we hope that we should be able to get approval in the next month or two on the outer side by July, August.
Ma'am, why 2 TAD date? Is it similar like plant and without plant inspection?
Yeah, that's the 2 TAD dates. But the extension of the TAD dates is based on the information request that the agency is making, and when we respond to the information request, they have an automatic 90-day from the response that they give us as a TAD date. So we've been trying to work with the agency to figure out how we can avoid that. So some of them are just clarifications that they're asking of us.
Okay. My second question is on R&D. So now you are down to say 3 billion a quarter. But at the same time, you are progressing in some of the complex generic products. You talked about Ellipta, Repsimit, etc. So my first question is, how should we look at R&D expense from here on? And if you can split R&D into your complex generic spend and NCE spend, that will be helpful.
Ramesh, you want to take that? The R&D spend?
You might like to answer the first part. We are pivoting to more.
Yeah. So overall, strategically, we've been pivoting to more of the complex generic platforms and continue to do so. So even when you look at our generic R&D spend at this point, the percentage oral solids versus complex platforms, inhalation and injectables has changed in favor of inhalation and injectables, and we continue to drive that shift towards complex platforms. I mean, the NCE spend that you asked about is very small in the scheme of things. Is less than 5% at this point.
10%
right?
really, but it's actually coming down to about less than 5% in fact in the course of this current fiscal. We're pivoting more towards into complex generics. So the salience of the oral solids is actually coming down. That used to be well above 45%. It's coming to much lower figures. And the spends for injectables and inhalations is certainly going up in the course of this fiscal, and certainly would be the way forward as well.
Just to clarify, so OSD, you said earlier it used to be 45% of the generic spend. It is coming down, and more is going for the inhalation and
inhalations and injectables for sure.
Okay, and my last, like your fourth quarter number include cost for the MR addition in India. Does it reflect fully, or like more to come in coming quarters?
Yeah, a huge chunk of it is actually captured in Q4, but there's of course the annualization impact of that because these were recruited in the fourth quarter. The annualization impact will certainly be captured along the full, the entire year next year. This fiscal, the current fiscal, that is.
Okay, thank you. I'll get back in the queue.
Thank you very much. The next question is from Kunal Damesha.
Hey, hi, this is Kunal from Macquarie. First question again on Spiriva. Would you be able to share the nature of the information requests that we are getting from FDA? And secondly, on the same generic Spiriva, would we have clarity as to whether we will require plant inspection or not by now? And if yes, hypothetically, let's say if we require, what is our preparedness? Have we done any mock inspection? Have we proactively employed consultants, etc.?
Yes, I'll take the second question first. That we have always been inspection ready in the Unit 3 for FDA in case they come to inspect the site for Spiriva. At the same time, we don't know for certain, but we believe that at this point we are pretty far along with the agency. The information requests that we're getting, beyond the last CRL that we responded to was really clarification on the testing method, sample size, and the like, the rationale for it. And what is giving us comfort is the fact that they started clearing parts of the application. We've already informed that the PD PK was cleared a while ago, and the fact that the DMF has been cleared last week, and we continue to get minor queries at this point gives us the comfort that we're pretty close.
Sure. And so we are still sticking to a September timeline or second half timeline for launch, second half of FY24?
We're hoping first half.
Okay. Because last time I think we said September launch for September 23 launch.
Well, so I think August was the outside TAT date. So we hope that we'll be able to get approval before that and be getting launch ready.
Sure. And secondly, I think, Ramesh, one for you, whatever cost savings that we have done, that is getting offset by some of the line items which have seen increase like sales and marketing, etc. But still, would it be possible for you to quantify in terms of, our target of 550 crore cost savings, which we said at the start of FY23, where would we be right now, and what's the runway left for us for FY24?
Yes, we have been able to achieve well over 325 to 350 crores across, at least 3 of the 4 levers that we have progressed along. There is, of course, some more steam left in so far as the inventory write-offs is concerned. And we believe on the idle time as well, which will, which is not a switch on, switch off kind of a thing. So it has to be over a period of time. So we will exercise those levers and potentially see gains over the next several quarters.
Sure. And I think last year we had a failure to supply penalty roughly around $27 million. Would you be able to share the number for this year?
Yeah, well, I don't want to actually make that explicit, but it has come down dramatically. It's in fact in a high single-digit numbers right now.
Sure. And lastly, on the profitability expectation for next year, would you be able to share any form of guidance or range?
We believe that the momentum would be sustained. So going forward, you'd like to see that Q2, Q3, Q4 would see successive improvements. For sure, after the launch of Spiriva and other products that he's speaking about, Darunavir and others in America, and of course there is expansion of Foster in Europe and the like. So with the cachet of products that we're launching across various markets, and that's actually you would see the top line lifting up to a double-digit growth rates for the entire year. And of course, with the tight leash on cost, you would expect the EBITDA margins also to go up. We do think that towards the end of this current fiscal, you would find a substantial increase closer to, in fact, where we think we should be, upward of 18%.
18+% exit run rate.
Yeah,
Exit run rate. Yes.
Exit run rate. That's what I meant. And for the full year, you could talk about at least upward of 15%.
Sure, perfect. Thank you and all the best.
Next question, please.
Krishnendu.
Yeah, hi.
Thank you very much, Kunal. Next, we'll take from Krishnendu Saha.
Yeah, can you hear me?
Yeah,
Yes.
Krishnendu.
Yeah, hi. Thanks for taking my question. Just want to get a hang of the US numbers for the quarter. This is flat. So just trying to understand, we had one extra month of Xenopex and Brovana. We had, I think so, we had an AG also in the mid of December. So, and we had a launch. So is this 175 sustainable? What were the misses and what were the plus additions to it, which get to this 175? I'm trying to understand that part.
Yeah, so the difference was 177 versus 175, $2 million. And there's a good amount of seasonality that you see in Q3, especially with flu products as well as albuterol. So, albuterol, while the share remained the same, the volume came down a little bit in Q4, And, but otherwise, Suprep was very strong, and offset some of that actually.
I see.
As well as we had, our inline products were fairly stable, I would say.
I
overall.
See. So Supra, we still have two-player market, right?
That's right, is the authorized generic and ourselves so far.
Post 180 days, we see this. How long do you think that this can continue? Any guess? I'm not an expert. I'm just trying to understand your view on this.
Yeah, it's hard to predict. So far we don't see any, any new entrant imminent.
And nothing on the last approval which we launched at the back end of the quarter. Velmity, the two-player market. Have we launched it? Could it be meaningful?
Which one are you talking about? I didn't catch that.
Tenofovir.
I don't recall having launched it in the US.
We haven't. Oh, okay, sorry, my mistake. I thought with 31st March we launched that. Nonetheless, thank you. Thank you for that.
Yeah.
Thank you very much, Krishnendu. So the next question is from Neha Manpuria.
Thank you so much. Vinita, on Spiriva, you don't see a scenario of FDA giving us a possible CRL, when the TAT date comes, right? Based on the queries that we're getting, or is that still a risk?
That would be highly surprising,
Okay.
I mean, It's hard to predict the agency at any point in time, but just based on where we are, we feel like we are, close to the finish line here.
Okay, got it. And second, Ramesh, if given Spiriva launch, etc., is still tough to predict, and there's also the market share that we end up ramping up to. If there is any delay in Spiriva, then how should we look at the margins from the 13% that we are doing? Could there be legs to the margin, or all of that margin guidance that we're given is dependent on the new launches?
I don't envisage a situation where Spiriva is going to be in doubt, but in the unfortunate event it does happen to be something like that, the base is set with the current levels, and we expect, in fact, better numbers to come in from our India business, and we have products across others also. So I would certainly say that there will be margin improvement, but of course, the needle really moves sharply when Spiriva is really launched.
I would just add to that, other than Spiriva, which of course will be the largest opportunity as we see it right now. I mean, we also have darunavir in June. We have, cyanocobalamin that we hope to launch out of Somerset in August. We have diazepam gel that we hope to launch in July. We have varenicline that we hope to launch. We have a TAD date of October for that product. And we have bromfenac, the ophthalmic product, where we exclusive first to file, that is at the tail end, March. So, while we have Spiriva as a major new product opportunity, we also have few others that will help us grow the business. Needless to say, I mean, the margin guidance that we just spoke about, there will be some impact if hypothetically Spiriva would not come through. But again, we've looked hard, we worked hard on cost optimization, and we'll continue to do that to make sure that we continue to drive our margins forward.
Understood. And Vinita, one other question on the US business. I think you mentioned in the television interview about price erosion being, if I heard correctly, low single digit, mid single digit. Just wanted to understand, are you seeing let's say things improve on the pricing erosion front, or let's say at least customers not coming back to you with repeated requests for price revision on the baseline products, given what's happening with the plants for competitors?
Yeah, we're starting to see that. And I think I said mid to high single digit, Neha, in the interview, but because that's a normalized level that we saw in previous years. We've given the supply chain challenges that companies have had. Our customers have become again very, very focused on reliability of supply, and are again engaging in more longer term relationships, contracts, or at least commitments, which gives us comfort that they are prioritizing reliability of supply over price. I mean, of course, they always like to get the best price, but they've struggled a lot this past year with the flu season products. So the flu season products in particular, we are finding that they're engaging with us in a more strategic dialogue on how do we really ensure that we meet the market demand, how do we partner to meet the market demand. So the partnering dialogue is gaining momentum over the transactional, model of business with our channel partners.
Understood. Okay, thank you so much.
Thank you so much, Neha. So next question is from Prakash Agarwal.
Yeah, hi, good evening. Am I audible?
Yes, Prakash.
Yeah, thanks. Just on the India business, we talked about, we expect double-digit growth. When we see April data, I mean, the month is pretty flat. Volumes are down 5%. So first question is, what is the strategy that we are following? I did hear you have added some MRs. If you could explain how much you have added with therapies and what is the strategy despite a very soft start for the industry?
Sure. We've added close to 1,000 representatives, and we've done 5 new divisions out of that. There's a 6th division that will come up in this first quarter as well. We're seeing growth across the board coming back. We're seeing growth on respiratory. We're seeing growth in cardiac. We're seeing some normalization of growth in diabetes even, and the intent would be for that to continue. good growth in areas like gynecology, for example. So I think the mood is extremely upbeat. Our own internal numbers on April look higher than whatever estimates we originally had. So yeah, I do think things are moving in the right direction. I don't think I think there's two of these of the divisions that we've added that have started giving us some returns. The others have we've just set them up in Jan, Feb, March. So that will really come in the quarters to come.
Okay, and what's the final count as on the March for after 1,000 MRs getting added?
Yeah, about 7,000 and about 9,300, all inclusive for the sales team.
7,000 is the MR with the managers and supervisors, or?
No, I believe it's 7,000 and 9,300, right? The numbers. So 7,000 MRs and 9,300, including the total sales team.
Understood. Fair enough. Secondly, on the the facilities issues that we are having across the US FDA issue, just wanted to have a flavor in terms of what is the remediation expenses we are incurring currently across, and as and when, which ones would be the first one that could get out of the FDA scanner, and by when? I mean, if you could just very ballpark, what is the thought currently?
Sure, we can talk about the remediation. I think the when they'll get cleared is a little bit of crystal ball gazing. I think the spend is definitely higher at this point of time. For example, there's a considerable amount of spend being done on nitrosamines and the like. Part of it would be for the industry as well, but certainly for us, basis some of the observations we had in Tarapur. So we've made great progress. I think we're close to remediation of that site. We're close to remediation of Mandideep as well. Pithampur, we're hoping with the next update we close out all the observations that we had. And the next step obviously would be to engage with FDA and get feedback. So, I think there is definitely additional spend at this point on the compliance front, which we would hope to see normalize in the second half.
That would be to the extent of what, couple of $1 million, or it's a larger number to look at?
No, it is larger than that.
Yeah. We spend fairly large amounts on consultants itself.
Okay, so about $10 million, something like that? I mean, some ballpark number?
Times two.
Okay. And this is annual, right?
That's right.
Yeah.
Okay.
Meaning there was a certain number in the base also. All of this is not incremental, but there is definitely room to optimize here.
Yeah.
Okay. And at best, it would be what, 6-12 months while we see a clean slate, or it could be long drawn as well?
Yeah. So a large part we expect to complete in the first half. So definitely there would be optimization that we would expect to get in thereafter. And some of it will flow into the next half as well.
Got it. And just last one here on, looking at past notes, we had talked about products pharma for injectable tie-up. Just wondering if there's any update. We had 2 tie-ups, if I'm not wrong, 2 injectables. Is
That's
that
right.
plan still on, or where are we on that?
Yeah, so they've filed doxycycline. I think we have a TAD date pretty soon. It is it's a product that we intend to launch in the next 12 months.
And the other one?
Ambisome is still in development.
Okay. And it is limited to 2 products, or are we planning more?
The Fordos partnership was the 2 products.
And are we doing more such types, or?
Yeah. So on the injectable front, we have a pretty active effort ongoing to partner as well as acquire injectable products that can accelerate our build of the injectable franchise.
You would have seen the approval that we had with some of the Kaplan points as well.
So we have, I think, 5 or 6 Kaplan point products that we intend to launch in the next 12 months.
Okay. Perfect. Great. Thank you. All the best.
Thank you.
Thank you very much, sir. We'll take the next question from Mr. Bino Padiparbil. Thank you.
Hi, good afternoon. We have a couple of questions. One, pegfilgrastim, what's the update? I thought that was also expected this fiscal.
Yeah, so we're just waiting to hear back from the agency on pegfilgrastim. We have, after the inspection of the Pune site, we responded to all of the queries that the agency had, and believe that we should be getting that approval if they have no objection. But we're just waiting to get that approval to really determine next steps with the product.
Understood. Could you please repeat the product you said, the ophthalmic product you said could get launched in March?
Bromfenac, Prolensa.
Prolensa.
Okay. And the list of products that you mentioned for launch this fiscal, do any of them depend on clearance of these FDA issues at the facilities, or are they all de-risked?
Actually, Bromfenac does.
Only Prolensa.
Yeah, Prolensa is Pithampur Unit 2.
Okay.
Yeah, which
Okay,
we hope to
great.
clear.
Okay, great. And finally, Ramesh, this year we had a very high tax rate. Going forward for next couple of years, what do you expect the reported tax rate to be?
As you can imagine, the tax rate, has been high only because of the fact that you had the loss-making subsidiaries across. But since then, actually, Brazil has turned around. America is expected to, of course, do well next year. So I expect the rates to come back to normalize to around 30% next year. It could be a little lower than that also.
Got it. Thank you very much.
Thank you so much, sir. So the next question is from Surya Patra. Thank you.
Yeah, thanks for the opportunities. So first question on the general overall cost. See, in fact, thanks for improved performance in the quarter, but still generally the margins are below par versus the industry trend. We know the kind of challenges what we have been facing, but having seen the kind of cost containment measures and all that, so we have started seeing some kind of sign of improvement. But could you give some sense that, okay, which are the key cost element that we are targeting currently and where that we can see some improvement? Because that will give some kind of confidence about it, because we have been under the sub 15% kind of margins since long. And one of our big revenue driving market that has been under loss. So could you give some key cost line items that you are targeting to really control? And also, what is the update on that hiving of the discovery researches division, what we have been talking about to improvise our overall margins? So let's say over next 2 to 3 year kind of horizon, what is the kind of a margin progression that we can see? And for that, what cost line items or cost items that we are really considering in this?
I'll start with the easiest. Starting with NCE, we have actually ramped down the overall infrastructure associated with that. So 150 crore spend is actually coming down to much lower numbers. That's the first. So essentially, we'll save close to about 70 to 80 crores on that. On the cost lines, yes, we do realize, whilst there has been considerable savings and progress along various initiatives, and I spoke about 350, 325 to 350 crores kind of savings, we still believe that there is a good 250 crores that is possible across lines like inventory write-offs, which still remain high because of products that we are dropping, impurities, nitrosamines, and the like, is impacting those as well. And that would of course come down. It's not as if it's going to be a situation of continuing for long. We've taken active measures in terms of looking at inventory control, and the evidence of that is really seen in the working capital optimization measures that were which is actually bearing fruit even in this particular quarter. There is a base below which it is impossible to go below, when it comes to, in fact, cost threshold, so to speak. So there is a minimum infrastructure that we need to maintain in terms of staff and across various functions. But for sure, we do believe that there is still some scope when it comes to, for example, facilities on the infrastructure, for example, on the R&D, oral solid dosages front, and so on. Because if we're going to keep it lower, then potentially there is scope for optimization. If the volumes are what they are, then potentially there is scope for footprint reduction across manufacturing lines and the like. So it is going to be a continuous process, but it's not as though it is going to be something which can be achieved within a period of 2 quarters or 3 quarters. It is going to be over an elongated run, possibly over the 18 to 24 months period. The only thing that we can actually assure you is that the focus is going to be constant. It is going to be it's going to be razor sharp in that sense. and we'll show you results over time.
Ramesh, if I can just add, I think first of all, at the gross margin line, I think you guys did a bunch of efforts around that. We did a bunch of efforts around that. A very large portion of that got wiped out by inflationary costs, as we discussed. Same way on the SG&A front, there's a significant increase. The majority of that increase is towards India and the related adjacencies that we have. In fact, we've optimized expenses on a bunch elsewhere. So, there is an optimization plan in the US that is actually what's helping getting the numbers to a better level at this point of time. But there's also an investment plan in markets like India that is resulting in an increase in some of these lines as well. So it's not going to look linear from that perspective. It's going to be different strokes in different markets, but US clearly moving down the optimization path, clearly the focus on new product launches as well. In markets like India, we're obviously investing. Like we said, we added the sales force. There's a cost attached to it that's just started. So there's going to be additional selling promotion spend that will come around that as well. But that obviously is with a clear visibility of return that we will give literally within 12 months, starting within 12 months from the time that we get the sales force on the ground. So I think the margin will obviously improve, but there are these forces moving things up and down a little bit.
True. Actually, I mentioned a lot of that at the start of the session itself in terms of my opening remarks.
Yeah, sure. So my second question is on the, let's say, all your effort towards the injectable, ramping of your injectable base. So the acquisition of the Medisol, this one recently that we have done. See, this is a very small company, although it is not very influential one to the overall size and this thing. But see, whether it is having any capability apart from the products, that is one. And secondly, on the injectable front for our existing key market, what is the kind of a core strategy that, or when are we expecting to see kind of a meaningful contribution from the injectable portfolio as a whole? That is my second question.
Yeah, so your two-part question on the injectables. The first, Medisol just gives us access to France. France is a market where we've had very little exposure right now. In Europe, we're really in Germany, UK, directly, and then France with the muscular. But this small, toehold, or so to say, just gives us entry into the hospitals in France, and it allows us to really take our injectable pipeline that we have put in place for the US as well as other developed markets and bring it into France. To the hospital segment in the France is actually pretty attractive for the portfolio that we have invested in. So it gives us a access point. It doesn't give us material infrastructure or a sales force, or it really gives us access to the market, and it's a very accretive deal. It's a small asset but accretive, which our focus has been on all our acquisitions to really buy accretive assets that don't dilute our earnings. So on the contribution from injectables, I'd say that fiscal year 25 onwards. So we have been building a pipeline. We have a good number of products filed. Even in fiscal year 23, we filed liraglutide, we filed glucagon, we filed, and the Kaplan products were filed. So we'll see 6 or so injectable products coming to market in fiscal year 23. There'll be 24 rather. There'll be the smaller products. The larger products, whether it's glucagon or Risperdal Consta, we expect in fiscal year 25. So that will be hopefully a big ramp up year for injectables. And then we are trying to figure out ways and means that we can accelerate that with products that we can partner, products that we can acquire. The US generic team is actively working on it to figure out how we can accelerate the injectable build.
Okay. Just a last question, if I may. On the domestic formulation business, how should we see? Because, having seen this segment really contributing meaningfully to everybody's growth who were present during the difficult time of the last 2 years. So, hence, everybody is now kind of trying to enhance, expand, or whatever in the domestic business. So, it is nothing but just enhancing the competition. So, while the growth of the industry or growth of the base is kind of known, and the trend is kind of getting followed only. So is it because of the incremental competition and everybody trying to have their share in that? So whether the profitability is likely to be compromised going ahead?
I couldn't help but smile when you were saying the message. I think there's a massive opportunity in India. There is a massive need in India as well. For example, the 6th division that we're going to launch is an extra urban division where we would go to doctors in geography that we don't even cover at this point of time. So I don't think it is competition with each other. Definitely, when you launch products, obviously you compete against other companies, but I don't think it's that, and I don't think it's going to have a reflection on pricing. There is an opportunity here, in the bigger scheme of things. I think it's the GDP, the amount of spend on, healthcare out of GDP, the affordability, the ability for people to pay, the people to get diagnosed and tested. That is the bigger story in India. And I think anybody who's really focused on India is, driven towards that story. Certainly we are. So I don't see this as a limiting opportunity going forward. I actually see this hopefully as something that should accelerate in the next few years.
Sure, sir. Wish you all the best. Thank you.
Thank you very much, Mr. Patra. Now, may I request Mr. Samir Baisiwala to go ahead with his question.
Yeah, thank you so much and good evening, everyone. Vinay, just quickly, how many complex injectables and inhalers have been filed? And what's the approval visibility over the next couple of years?
So on the injectable front, we have a few. I mean, glucagon that I mentioned, I think 4 or 5 products, the liraglutides, glucagon, ganirelix, and then of course the 4-dose product, doxycycline. On the inhalation front, it's been the products so far in terms of Spiriva and Dulera, but we've been like this year we filed a couple of 3 nasal sprays as well. So while smaller opportunities, but still meaningfully add to the respiratory portfolio. And I'd say that the Ellipta filing as well as Respimat should really happen in the next fiscal year. We are making good progress on these products, but in terms of the development cycle, based on where we are, they will really be fiscal year 25 filing.
Okay, excellent. And just talking about albuterol, what's the outlook for the current year, fiscal 24, both in terms of pricing and is there a room for market share gains over here?
If there are any market disruptions, we certainly will be ready to take share. I mean, so far the market has been fairly stable, and we've got this 20% plus share, and we hope to be able to sustain it at current pricing or as close as possible. So, I think if there are any disruptions, certainly we'll have the opportunity to gain share. But it's it's turned out to be a really nice product for us.
And you said you expect the pricing to be stable for the foreseeable future.
Yes, we think so.
Okay, great. And just one final on India. For the full year fiscal 23, I see you have grown at 1% or so. Whereas the price increases, I would imagine, have been more like 7-8%. So does that mean there's been a quite big volume erosion in India? That's one. And second, what's the pricing outlook for fiscal 24 for India?
Yeah, so I think the bigger story we impacted on diabetes, and definitely we deep grown there, right? So, and from a value perspective, so that certainly happened. As far as the pricing outlook, so obviously, the WPI was 12.2 or the like. So for the scheduled products, for the most part, we would have taken that increase. We typically don't take it on anti-infective, for example. And then obviously we optimize other products and take an annual increase as well. There have been input material increases as well. last year. So I think we definitely wanted to take more of the increase. Typically, I think in the non-scheduled portion, 5-6% is the price increase that you end up sticking to. So I think the pricing, last year, if you take out diabetes, it's a growth story. With diabetes, it's actually a degrowth. So from that perspective, obviously, there's significant room to move. That diabetes part is starting to stabilize. Diabetes is about 20% of what we do in India. So there is direct impact on the overall India number when we do it. But we're starting to see all of that starting to even out. Respiratory was slow to start with. Now that's growing nicely. Cardiac is starting to get to the double-digit number as well. We basically see everything. And diabetes will not, but I think other than diabetes, everything else will be at double-digit.
And Nilesh, just to conclude on this, after 7-8% price increase last year, 5-6 this year, 14% put together. You think markets, doctors are quite okay to absorb this kind of price increase? I can't remember when last we had such high price inflation in the drug industry. Therefore, I'm asking.
Yeah. So as far as these controlled products, as you know, there was an additional NLEM list. So net, there's actually a negative impact on that portfolio from what happened in November, December. So on that, that list of products which was there, obviously there is an impact. I'm not sure where you're getting the 7-8% from. That certainly was not our price increase last year either. But
that's a number you get if you see industry-wide volume versus value growth for the industry as a whole and most companies, and that's where it's coming.
No, I think that would also be the portfolios as they're shaping. If there's going to be more oncology, then the value will go up and everything. But I can't comment on that. You can comment on that better. From our perspective, I think, obviously we look at products very closely from affordability as well. Certainly with our peer set as well, we would not be priced at the lowest product. We would certainly not be priced as the most expensive product as well. And there have been significant cost increases which have happened over the last couple of years, right? If you look at the base products, look at anti-infectives, look at vitamins, look at some of the starting materials out of China, massive inflationary costs. It's the same thing that we're explaining on the gross margin line. You can't directly pass them on in India. I think you only get an opportunity once a year to go and address that. And you would address it where it's possible to do, where you feel that it's not, you don't.
Okay, great. Thank you so much.
Thank you so much, sir. The next question is from Mr. Madhav Marda, please. Thank you.
Hi, I just had a few questions. Just wanted to understand on the R&D side, we're at about 7% of sales in Q4 and about, I think, 300 crores on absolute basis. I'm not sure if you gave some guidance in terms of where we could be as a percent of sales or an absolute basis. If we should be like annualize our Q4 number, or can this go up?
No, so essentially, so there would be actually pivoting to more complex. So, but the magnitude will be around the same vicinity, between 1,300 to 1,400 crores max.
13 to 1400 crores R&D. Okay.
Yeah.
And then the second question was on the India business. By when does the diabetes portfolio generalization impact come through in the base? Like, is it Q1 FY24 where it's fully in the base and then sort of we can start growing at a faster pace?
No, it goes into, I think it goes into 25 as well. I think as some products go, right? So I think there is definitely, if you look at what's happening, so there's two things here, right? Products that we would have in license where, competition comes in, or we reduce pricing in line with competition, or other products which are getting genericized. Both of these things are the two elements eating away at diabetes, right? So you would have seen in the DPP4s, one by one, each of them has been going off patent. In the SGLT2s, same way that's been happening as well. That keeps impacting the market over time because, certainly certain prescription behavior keeps switching when, a higher priced product remains, but a lower priced in the same category is available as well. I think that will go on till 2025. From our India region perspective, while that's a top line story, it's not a bottom line story because in the in-license portfolio, obviously you make a lower margin profile versus products that you would make yourself. But I think we obviously enjoyed the wave of the increase in the entire diabetes sales over the years as these new products were brought to market by us. But on the flip side, we are seeing this as well. I think it's part of life. It's going to pan out in the next 2 years. But till then, the growth I think on diabetes will remain possibly, in my opinion, possibly high single digit, not get into that double digit category.
Got it. And just one clarification, you mentioned about a 250 crore cost impact from the nitrosamines. Could you just clarify what that was? Like that's a saving which can come through?
250 or anything like that. We said about $20 million, about 150, 160.
Well, we said $20 million on consultant spend. We did not
total,
say
total everything put together.
Quality, GMP
facility remediation. Okay.
Yeah.
Okay. Thanks a lot.
Thank you so much, sir. Can I request Mr. Chirag Dagli to go ahead with this question, please? Thank you.
Yes, sir. Thank you for the opportunity. So we spent 1,500 crores capex, organic capex in FY23. Can we have some details on what this capex is on? And a much larger question.
Including acquisitions. No. So essentially, a chunk of that, the capex is far lower. In fact, less than half of what you're mentioning. A huge chunk of it is actually for M&A. It is spread across. In fact, what we bought in India, what we bought in Australia, and what we bought in America.
So there's a separate line item, Ramesh, which says payment for acquisition of business. That's 291 crores. That's separate. There's also another one on capital expenditure on property plant.
Vishal, speak up.
So what you're seeing there on the acquisition, that's only for one piece, which is on Aptil. All the other acquisition, whether it was with the Synovian for Xopenex Provana or the Paloma acquisition in Brazil, those are all getting accounted in the line, which is where you see the capital expenditure. And both this acquisition, specifically the Synovian one, was a significant one from an acquisition perspective, which we did this year.
This line item says property, plant, equipment. These.
So we need to clarify it.
It's intangibles, actually, what we bought into brands and so on. So it's actually coming as part of
But
that.
I think, like we said, the capex is basically of the order of 600, 700 crores. That's global. And about half of that would be really going towards maintenance kind of spend, and the other part would be for newer capabilities.
Yeah. So both lines together is 1,700 odd crores is what you see overall.
And we hope to maintain this kind of run rate, 600-700 crores organic capex.
The capex would be around the vicinity between 600 to 700 crores. So potentially M&A is really going to be based on the proposition that presents itself. No?
Understood. And this, this M&A, we keep doing these small, bolt-on deals. My question is really, is there an internal hurdle, IRR, payback period, return on capital? How are you thinking about how
Of course, we do have that.
It
really varies because, for example, if you take the Medisol thing, it is actually very strategic. So of course the payback period is, it's very reasonable from our perspective. So it really is dependent on the proposition and what does it do to our overall portfolio. On the respiratory space, for example, we found an opportunity with Brovana and Xopenex. So essentially, Paloma, for example, helps in actually stabilizing the overall portfolio in Brazil. So it is actually a bit of strategy and, of course, the kind of returns associated with it.
For all of them, our focus has been on, quick payback and high IRR
and being
EBITDA multiples.
EBITDA accretive as well, as much as possible in the very first year.
So we've spent about 1,000 crores on these acquisitions, right? 1,700 crores of overall capex, like you're saying.
Yes, that is correct. Everything put together.
So my question is this 1,000 crores, if you can just give us a sense of how are you thinking about payback periods, IRRs, or whichever way you're, slicing. This seems like a fairly large amount. I would have been surprised if you would have told me, 12 months back that you would spend about 1,000 crores. With a single digit ROIC, you would spend about 1,000 crores on M&A. I'd be surprised. And that's the question, that how have you evaluated?
Our threshold limits are, as I said, it is pretty high. So I would say anything north of 19 to 20% on an IRR basis, which includes, in fact, a terminal value of that. So even without that, it would be well above 16%. From our perspective, it actually adds economic value to us. Our cost of funds is about 11.3% or and thereabouts. So to that extent, all of these propositions, as well as they are well above those limits, it makes sense to us.
Understood. And just the last question is on the tax rate. At what point do we become a normalized, tax rate company?
So in the recent past, we have been inhibited by, in fact, losses in various subsidiaries, and that included Brazil and America. And of course, we will still have our R&D entity at Anomi in Netherlands. That would potentially be because it's more R&D spends, but we do expect the other business subsidiaries to start making money for us, as was the case in America until very recently. So effective tax rates would actually normalize around the 28 to 30% mark from next year onwards. Though if you recognize India itself, it's much lower tthan that.
So FY25, you're saying 28 to 30%?
And FY24, the current year, we would bring it down to about 28, 30%.
Understood. But a normalized rate should be 25, Ramesh.
It could be, but that so you could expect that out of India, because it is possible. If I would move to regime 2, in alternate regime, but of course we still have tax breaks in India, so that's why we're still sticking on to that. But if we talk about other parts of the globe, incremental tax rates are in the vicinity of 30%, in most parts really. So it is really a function of those. In America, for example, you still also have federal, apart from federal taxes, you have state taxes as well to reckon with. And even if you, so there is an NOL, so to the extent you won't be actually making any, paying any payments out, tax payments out there, but there's still some federal tax out there. State tax out there.
Okay, thank you so much.
I know we're at the hour, but maybe last 2 questions.
Thank you so much, sir. Next is Ms. Cinderella Carvalho, please. Next question.
Yeah, thanks for the opportunity. If I can understand, if we are looking at the coming quarter in US, it will be seasonally weak quarter, right? If I follow our general trend. Do you see our quarterly run rate of 175 million sustaining, or should we assume it more towards the seasonality that we always consider? Plus, with the US base, can you help us understand how Suprep is expected to pan out for the coming entire fiscal FY24 along with Albuterol? Do you think these both products will continue at the same level for us today, or you see that they will see some competition, though you highlighted earlier that, you do not see meaningful entry in Suprep yet. But any further thoughts will be helpful. That's first question.
Yeah, so you definitely will see seasonality impact in the first quarter for the US business. All the anti-infectives, cephalosporins, azithromycin, oseltamivir, all of that portfolio will be down. So there will be an impact on revenues, but we have some upsides also. We have the Darunavir launch, and we'll see when we can launch Spiriva, June or July, based on FDA approval. We have some launches as well to offset it. But, for us, once we launch Spiriva, that's where revenues pick up in a major way in the US. But otherwise, the seasonality will have an impact in the first quarter.
And on Suprep and Albuterol?
Yeah, so Albuterol is already a multi-competitor market, and we believe that it's stable from the standpoint of competitive and from a share perspective for the competitors. We don't see any near-term entrant in Albuterol in the next 12 months. On Suprep, it's hard to tell. We don't believe that there is any imminent approval right now based on what we understand of the supply chain. But, it's hard to tell how long it will remain exclusive. We think the next 3 to 6 months, it could be beyond that as well.
Okay. And if I have to understand the overall scenario X, these new launches, like if we keep Suprep aside, do you see the price erosion at the mid to high single digit run rate only, or do you think it is higher than that?
No, we think that it's gotten to that high single digit run rate, but for the new products like Suprep.
Excluding new products, right?
Yeah.
Right. And if I may understand, Ramesh, how should we look at the hedging rates for us? Can you give us some idea around the coming quarters? Where are we?
There's this philosophy that we should not hedge fully. The currents are current. The current at least trends kind of indicate it's going to stagnate around the 82 mark. But given the volatility around the economic front, it's good to be actually open at least for a huge chunk of our portfolio, and that's what we have actually done. We have booked some things for the future, and those are well into very acceptable rates at this juncture. But a fairly large chunk of our overall exposure is still unhedged.
Okay. And if I may ask one more question on the API side, what is keeping this kind of growth in the API? Do you think there is some seasonality to this, or you think this is sustainable? And what were the key drivers for the API segment to outperform? Can you please highlight and help us understand? A little more granularity will be helpful.
Okay, Cinderella, we'll have to wrap up after this. We're already 5 minutes over time. As far as the API business is concerned, we were basically doing very low in the first 3 quarters. And there's really been a successive build over the quarters on the API business. Every quarter the business grew. And, in Q4, obviously, we've seen a lot more normalization in products like 7-ACC and Cefaclor. That's really what's driving it. We expect it to continue. We don't expect this growth to continue, but we would expect it to kind of continue more or less at this kind of levels.
Thank you so much.
Last question, please.
So, can I request Mr. Kunal Landeria? Kunal, are you there? Hello.
No, so I think we can
it's
wrap
okay.
up.
We can wrap up there.
Yeah, am I audible?
Yes.
Oh, thanks for allowing me to squeeze my question in. Vinita, just a couple around Spiriva. Now, is my understanding correct? The Spiriva volumes have been shrinking, and even within that, Respimat share has been rising. So, which means your HandiHaler has been maybe going down in double digits in the last 5 years.
That's right.
So just, what is your expectation once the HandiHaler generic comes in the market? Do you expect some shift back from Respimat to HandiHaler?
We haven't assumed that, but hopefully that happens. From a pricing perspective, that the retail, retailers have the incentive to shift some.
Right. And what would be the market size today at the manufacturer level?
It's, I think, a gross level still billion plus at the gross sales level.
Okay, but at the net level, maybe 500 odd. Would that be a correct understanding?
I would think so. But, from a pricing perspective, it's really the gross level that is important.
Sure. Okay, perfect. Thank you and all the best.
Okay. So thank you. Do we have another question, or can we wrap up?
Yeah, I think that pretty much concludes our Q&A session.
Okay.
I now hand the conference over to the management for closing comments, please.
Okay, great. Well, thank you, everyone. Hopefully, we've been able to, respond to all of your questions. If not, I'm sure you'll be following up with Ramesh. But as we mentioned at the outset, we are very pleased with the progress we have made through the year, through fiscal year 23, closing the year on a positive note in terms of EBITDA margin improvement. And we continue to be very focused on driving, profitability as well as growing our business into fiscal year 24 with new product launches as well as the basic business, India business, as well as other parts of our business. So look forward to a successful fiscal year 24, and we'll look forward to speaking with you again in the next quarter. Thank you.
Thank you.
Thank you so much to the management team and the panelists. On behalf of Lupin Limited, that concludes this conference. Thank you for joining us. And you may now disconnect your lines and exit the webinar. Thank you so much.